you're an investor who wants stocks to go higher, this is what you're hoping for. You're hoping for that unemployment rate to skyrocket. This way the Fed stops raising rates. You're hoping that demand falls off a cliff, so the Fed stops raising rates. You're hoping consumers stop freaking spending so much money, right? This is what the bullish thesis is. This is what we need to see for the Fed to be like, okay, we see inflation coming down. We all know inflation's coming down in some areas. I've covered it for 9 months, even 7 months and 5 months, showing different areas where it's coming down. We've seen oil prices coming down. Copper prices did go up a little bit. We're seeing prices come down here and there. But what the Fed looks at is not really coming down. It's not coming down as fast as they want it. And it's not going to for a while. Because rental income is going to stay relatively high. Food prices relatively high. Oil has come down, which is good. But if you strip out food and energy, which they like to do and call it the core, and we finally peaked a month ago, and we better hope that it's still going lower and lower. It has to go. It has to, right? Over time, go. It's just the pace and how fast it can go lower, but it's not coming down fast enough. And that's what the Fed's looking at. This is why the Fed's backed into a corner. Since they'll eventually achieve all these goals by raising rates and removing trillions of liquidity from the market, by shrinking its balance sheet. That's exactly what they're going to do. That's what they said. And everybody agreed. That's exactly what they're doing. But the question is, once we have millions of more people who are unemployed, and this is going to be by mid next year. This is what the Fed is predicting based on all the moves that they're doing. So once we have that, we have the housing market incredibly weak since most consumers can't afford to buy homes due to 6% plus mortgage rates. Once we have demand really falling off a cliff, more than 70% of the companies in the S&P 500 are going to see earnings fall by 15% plus next year, which they're projected to rise 7% next year, which is crazy, even though the Fed's pushing all these the Fed's doing everything it can to crush the economy. Where do you expect stocks to go? Because this is the bullish thesis. I'm going over the bullish thesis for you. And you know you listened to me for a while, for a very long time. I've been doing this for 15 years. I'm optimistic about everything. If there's like 50 people that I have to fight, I'm giving myself a chance. I'm always optimistic. That's the way I am. And right now, I'm trying to find the optimistic case for stocks because this is the bullish case. The Fed's going to slow down, and we're going to see, unemployment because demand's going to shrink and demand's going to contract tremendously. We haven't seen that yet. But this is the bullish case. For the Fed to stop raising rates, they need to crush the economy. They need to crush the economy. And the Fed's not going to be there to back you up like it was the last 12 years, like during COVID, and injected trillions into the system. They're not going to be there during the credit crisis, injecting money into the banks. They can't do that. That creates more inflation. They can't have rates at zero, which we saw basically for the last 12 years. They're going to be well above those levels, well above 4% for the entire year next year into 2024. But that's a bullish case. Now you have to ask yourself, is all this priced in with the S&P 500 down 15% from its highs in 2022? Well, 15% sounds like a pretty big number for the S&P 500. Wow, you're down a lot, Frank. This could be factored in. But the S&P 500, listen to this, surged 27% last year, popped 16% in 2020. I bet you if you ask most people what the S&P 500 do in 2020, they'd probably tell you I think it was down. It went up 16%. It crashed 35%, but when you inject 50% of the country's GDP, over $11 trillion into the market, directly to consumers and businesses, what do you think is going to happen? They're going to spend like crazy. So you push forward all this demand. And in 2020, the S&P 500 it jumped 16%. And in 2019, what happened? It rose close to 30%, even though we saw earnings year over year from 2018 to 2019 fall. It fell by $1 from 160 to 159 total S&P earnings. But still, the S&P 500 surged in 2019. Why? Because Trump went on a rampage and said, we need rates to go lower. And the Fed started easing because we had inflation in check at 2%. They said, okay, let's start easing, get those rates under 2% again. And we saw 2019, but that's the last 3 years of the market. 27%, 16%, and 30% returns the S&P 500 last 3 years before this 15%. So when you put that in perspective and you're looking at it, you're saying, wow, is that 50% decline enough? Considering we injected all this money into the system that now the Fed is doing everything in its power to remove, should we fall back to 2019 levels? That's why earnings were $160. They're projected to be $235. Holy shit, how could that happen? Not to mention, during those 3 years, we had interest rates were near zero. In 2019, we started lowering them, but before that, we were raising a little bit, but interest rates were considerably low. They're much, much, much higher now. We really, at those levels, you couldn't put your money anyplace else. Like, I have to have it in equities or at least dividend-paying stocks, and they're yielding 1.8% or whatever by blue chip. Now you could earn, 4% risk-free in the 2-year treasuries? Risk-free? So I'll tell you, someone's been doing it for a long time. It's impossible to figure out how this is going to play out next year. But what I do know for a fact, I could say for a fact, I'm 98% sure, it's going to be one of the most volatile periods in markets that you're ever going to see. We're going to see earnings crash for most companies as demand falls due to the Fed. And that's why I've been saying buy long-dated puts. Go 9 months out. It's not just protecting your portfolio. You can make a fortune on these things because you're basically saying that these companies aren't going to meet the earnings that they're going to meet. And you see 20%. How many companies do we see 20% declines? We saw a lot of these things run up. We saw a 6% rise in the NASDAQ in one freaking day. Incredible, incredible number. So if you're short, you're just, you're blowing out of everything and we just tell you you're sleeping on a park bench. But long-dated puts, you're only losing the money you put in. So do a money flow trader. So if you're looking 9 months out, 12 months out, you're betting that they're not going to meet earnings estimates where you see a 20%, 30% fall, especially early on. Next quarter, which usually seasonally is a weak quarter for these companies. They're discounting everything. It's going to be hard to keep margins up. Yes, sales are great, but your margins are probably going to be a lot lower, which means earnings are going to be lower than expected. So if they miss, especially with higher expectations as the market's kind of like a little bit in rally mode off of its low since October still, what do you think is going to happen? That's why Goldman just came out. Said, look, we haven't really seen the worst of this yet. It's going to get ugly. But be careful what you wish for. We're wishing for demand to get destroyed, for unemployment to skyrocket. That's the bullish case. That's the market we're in. A market that the Fed put us in. I'm not ragging on the Fed because everybody can rag on the Fed, but that's the market that they put us in. When you keep rates super low for such a long period of time and you didn't see inflation, now all of a sudden it rushes in, the $11 trillion that you spent. Now you're fighting to get this out of the market, saying, we're going to try to avoid a recession. What? How do you avoid recession when you're taking trillions of liquidity out of the market and you're aggressively raising rates by the fastest pace you did in the Fed era? 475 basis point hikes, and it's not a given that the next rate hike on the 14th is it going to be 75 basis points, depending on the data. But there's nothing there evident that, forget about the word pivot, it shouldn't exist when we're talking about the Fed, because a pivot means that they're going to lower. They're not lowering rates anytime soon. Probably 2025, maybe. Unless we see some kind of crazy event when the market crashes and all demand falls off a cliff, it gets crazy. But they're not going to reverse course because they made it clear we need to see inflation under 2%. That's not going to happen. It's not going to happen for a very, very long time. Maybe they stop. Maybe they pause. But we'll see.